So, good morning to all of you. Welcome to our webinar. This is our first financial reporting webinar of this year, and it's on the consolidation package IFRS 10, 11, and 12. And we are doing so after we had 7 non-financial reporting webinars in January. It's also our first user-focused panel webinar, and we are very pleased to do it again with EFFAS and the Belgian member of EFFAS, ABAF, BVFA. Before handing over and before introducing Jesus Lopez Zaballos, the president of EFFAS, I would like to make some admin points to you. So you will see that we have polling questions. Actually, the first one should come on the screen now, where we ask you about your background, but you will have several ones during the webinar, and we ask you to complete them because that gives us some additional information, and we will discuss the results with you. Then, secondly, you have the possibility to ask questions or make observations like you wish. You type in the box that is on your screen your question, and they will be conveyed to the panelists and the speakers so that they can react to it. And then the last thing I would refer you to is you will see slides. You may also be curious who is actually participating in this webinar. So you should go to the EFRAG website, to the meeting, and there you'll find all the documents. So you find the slides there, the participant list, and also important, the program and the bios of the speakers. We also have to announce that there is a little change to the program. Unfortunately, Theodore Sven-Nielsen could no longer be there. He had an urgent issue to handle. So we have changed the program a little bit for you. Serge Pattyn very kindly agreed to join the panel, so he will be now in the panel discussion. And my colleague Patricia McBride, director here at EFRAG, will kindly step in and do the takeaways and say goodbye to you. So let me now first introduce to you Jesus Lopez Zaballos. We are very delighted that he comes here to do the opening words. As I said, he's the chairman of EFFAS, the Executive Management Committee, and he is general manager of the Instituto Español de Analistas Financieros, EAAF. And he's a board member of ACIIA, ILPIP, and so on. There are several things mentioned, so I advise you to go to his bio, which is on the website, where you find everything about him. Jesus, I'm going to give the word to you and to ask you to address our audience, which we unfortunately cannot see, but we assume they all will be there. At least the number of registrants was very, very high for this webinar, and from all over the world. Jesus, over to you.
Thank you, Saskia. Dear all analysts, financial professionals, IASB and EFRAG members, I'm very pleased to welcome you to this webinar jointly hosted by EFFAS, ABAF, the IASB and EFRAG. As investment professionals, we monitor and analyze listed companies all over the globe. But major listed companies are rarely single entities. They usually consist of a diverse range of subsidiaries, associates, joint ventures, and other arrangements. For us, as users, it is important to understand the structure and relationship of this group, as it helps in understanding the overall profit and cash flows, as well as the relationship between the various parts of the groups. In financial reporting, we have been applying the current set of standards, IFRS 10, 11, and 12, for a number of years now. These standards changed practice significantly, as the previous consolidation practices were often based on strict rules, such as requiring consolidation when ownership of a subsidiary exceeds 50%. Because the consolidation requirements in IFRS are based on control or joint control, another significant change was that IFRS standards did include the previous common practice of proportionate consolidation. The concept of control is of high importance in our vision of the results obtained. Today, we think the time is right for a post-implementation review, as we have now had significant experience with these standards. We are holding this webinar to find out what you, as users of financial statements, think about the requirements of these consolidation standards and the information that they ask companies to provide. To lead us through this webinar, we have a strong lineup of experts, speakers, including Tarca, who is a member of the IASB Board. The panel of experienced users of financial statements will be introduced to you by Hans Buysse, EFRAG Vice Chairman and EFFAS Board Member at the start of the panel session. We hope you will provide your views during the panel session as actively as possible and follow up by sharing views with EFRAG for them to collate and send to the IASB. Thank you for joining us today, and I will now hand back to Saskia to introduce Tarca. Thank you very much.
Yes, thank you, Jesus, and thank you very much for your warm welcoming words. We launched the first doodle poll with you, polling questions with you, and actually it's very interesting to see that our user panel attracted a lot of preparers as a sort of an accountancy professions as the first category of people participating, but we are very happy that we also have some users, and we encourage you when there are more polling questions which will be launched during the panel discussions to complete them. So I'm now very pleased to hand over to Tarca, who will give us some insight in the reasons, the how, what, and so on of the post-implementation review of the consolidation package. Well, you know that Anne is an IASB board member, so she's very important, and she has been for several years now on the IASB, and her background is an academic. She is or has been, I don't know how that works, still professor from background, and she was also a member of the Australian Accounting Standards Board. Again, go to the bios if you want to know more about Anne. And I'm going to hand over to you. Anne is referring as well to the slides, which you find, as I said, on our website, but you will have seen them as well on the screen. Anne, for you.
Thank you, Saskia, and good morning, everyone, or good morning, good afternoon, good evening, depending on where you're located. It's a great pleasure for the IASB, myself, and staff members to join you today for this webinar. So we do thank EFRAG, EFFAS for organising, and it's a great pleasure to be here. So we do have a slide deck. As Saskia said, the slide deck is available on the website, and it's going to come up on the screen now. So, Robert, if we could have our slides up, that would be good. Thank you, Robert. As we already know, we're looking at IFRS 10, 11 and 12 today in this webinar, but in particular IFRS 12 in relation to disclosure requirements. Next slide, please. Our presentation today is to give background to the panel discussion and your questions that are going to follow. So I must point out that any comments I make are those individual views, and the same applies for the IFRS Foundation staff who are joining in this webinar. Next slide, please. So the post-implementation review, slide 3 shows us with the red arrow just where we're up to. So we published a request for information in December of 2020 with a 150-day comment period that will end on the 10th of May. After receiving the responses from stakeholders, the board will consider the findings of the outreach activities like this one and other evidence that's collected to determine what the next steps will be. So the next steps could be one or more standard setting projects, it could be research projects, or indeed the board may decide that no further action is needed. So your input today is very valuable, and we're very interested to hear your comments today from panellists, through questions from participants, and we will be considering all the feedback we get from today's session. So thank you in advance for your participation. Next slide, please, Robert. So slide 4 just gives an overview of the slide deck. For the next few minutes, I'm going to talk to you about these various things, just briefly on the request for information, then more detail on the disclosure requirements in IFRS 12, and also some examples, and then a couple of questions that we'd like to throw out for discussion today. There are 2 appendices, but we won't be dealing with those in any detail. So, as we've said, the purpose for today's session is to give some overview, high level, of the request for information, but more importantly to get feedback from users and from other participants about the request for information, in particular whether the IFRS 12 requirements are resulting in the type of information that's meeting user needs regarding subsidiaries, joint ventures, associates, and unconsolidated structured entities. So next slide, please, Robert. And indeed, next one again. So slide 7 gives us an overview of the request for information. Looking at the 3 slides, in IFRS 10, the request for information raises questions about a number of things. So various aspects of the assessment of control, also the consolidation exception for investment entities, and also some particular accounting requirements in relation to IFRS 10. For IFRS 11, the RFI focuses on collaborative arrangements outside the scope of IFRS 11, on how to classify joint arrangements as either a joint operation or a joint venture, and finally some accounting requirements related to accounting for joint ventures. The 3rd standard, IFRS 12, the focus of that standard is the disclosure requirements in relation to IFRS 10 and IFRS 11, and that's what we're going to look at in some detail now in the next slides. The PIR has really one overarching question on IFRS 12. So the PIR is seeking feedback on whether users are getting the information they need, whether information is provided that is unnecessary, or the information that they do require and they're not getting. So they're the types of things we'd like to find out about. Next slide, please. So IFRS 12, the disclosure objective, you can see it there on slide 9. High-level disclosure objective, requiring entities to disclose the information that enables the users of the entity's financial statements to do 2 things: looking at the nature and the risks associated with interests in other entities, and then getting an understanding of the effects of those interests on financial position, performance, and cash flows. Looking now at slide 10, we'd like to unpick those disclosure requirements a little bit in the presentation, giving some high-level comments on what the disclosure requirements are within IFRS 12, and then also looking at some examples to illustrate them. So the areas we need to look at are the significant judgments and assumptions, secondly, disclosures about subsidiaries, thirdly, joint ventures and associates, and there we have a couple of questions for you that the staff have found in their own research that they've been doing. And then the 4th area is to do with structured entities. So looking now at slide 11, the first areas regarding disclosure is to do with the significant judgments and assumptions. So the board, in writing this standard, wanted disclosure that would enable users to understand how the entity has gone about determining whether the entity has control or not control, so significant influence or joint control, and also how the entity has determined whether the joint arrangement is indeed a joint operation or a joint venture. We've already touched on the topic of control in the introductory remarks, identifying that this is fundamental to the standard, so disclosures that inform people how those judgments of control are made are also very important. In the example on slide 1, this illustrates some information that the entity has provided in relation to their determining control. So in this example, the company indicates that it controls the subsidiary even though it has less than a majority of voting rights, which in this case is 50%. So the reason that the company concludes that it controls the subsidiary is provided in this example, and we can see that the casting vote held by the chairman is the influencing factor for the entity making the decision about control. If we look at another example on slide 12, we can illustrate this is an example around significant influence. So although a 25% interest is held, the company determines no significant influence because the company states that it is unable to exercise significant influence over financial and operating policy of the investment. So that's just a couple of examples of how people have gone about communicating in relation to the significant judgments and assumptions that are being made. Going now to slide 13, we'll talk a little bit about the second area of disclosures, and that's in relation to subsidiaries. So there are specific requirements in the standards about the sorts of information that should be provided, disclosures to be made for each of the subsidiaries for which the entity has, for each of the subsidiaries that have non-controlling interests that are material to the reporting entity. So going to the next slide, we can see an example of that. So on slide 14, please. So slide 14 gives us an example where, in this case, there are 4 subsidiaries that have material non-controlling interests, and the information is provided in relation to the profit that's attributable to the non-controlling interests, dividends paid to them, and the equity attributable to non-controlling interests. So specific disclosure in response to the requirements in IFRS 12. Going now to slide 14, I beg your pardon. Going now to slide 15, some further disclosures in response to IFRS 12, paragraph 12. And in this slide, we can see for each of those 4 subsidiaries information about assets, liabilities, revenue, profit and loss, total comprehensive income, and the net cash flow. Could we go to slide 16, please? And just finishing off this section with another example that we observe, and that's in relation to significant restrictions on the assets held by the subsidiaries. So in response to a requirement of IFRS 12, this entities provide an example of restrictions on the cash held by partially owned subsidiaries. Thank you. Can we have slide 17, please? The third area of disclosures that we wanted to touch on was in relation to joint ventures and associates. So that's the equity accounted investments. So the disclosure around these equity accounting investments is broadly can be classified as disclosure of the material joint ventures and associates and aggregated disclosure of the individually immaterial ones. So we've also got a couple of examples of this. So slide 18, please. Okay, so example 5 here, you can see the 2 associates, A and B, 2 joint ventures, C and D, and you can see the sorts of information that has been provided in relation to assets and liabilities for each associate, giving a total for material associates. Also in this example, the entities provided the reconciliation from the share of the net assets of the associates and the joint ventures to the carrying value that appears in the balance sheet. Slide 19, please. So further information about the material joint ventures and associates, as per IFRS 12, there's information there about revenue and other particular line items that represent summarised financial items for each of those associates and joint ventures, provided because they have been assessed as material. If we look now at slide 20, we have an example where the joint ventures and associates are individually not material, and the standard permits an aggregation of those immaterial joint ventures. So the type of disclosure that one might see is as shown here, where it has been aggregated and the information is presented at this high level. Now we'd like to talk to you now about two areas that have come up as we've been researching. So slide 21 refers to segment information. So this is the first question or thing that we particularly noticed, and we'd be happy for some discussion on this today. So from our research when we were looking at disclosure, we found that some companies provide segment information that includes a share of revenue, profit or loss, assets and liabilities of joint ventures and associates when these are accounted for applying the equity method. This, of course, is not prohibited by IFRS 8 operating segments, which takes a management approach, but we have observed that some companies have chosen to put that information within their segment note. If we look now at slide 22, we can see an example. So inside the red box on the screen on slide 22, you can see that the share of revenue and profit and loss of the associates and joint ventures are added in to the segment information to arrive at something that in this slide is being called combined revenue. We also saw other examples where people took a similar approach and added in assets and liabilities from the associates and joint ventures. The second set of findings that we'd like to talk to you about related to the individually not material joint ventures and associates. So in practice, we were observing that some companies carry out their operations through a large number of joint ventures and associates that are individually immaterial. So we observed that because individually immaterial joint ventures and associates are not required to be disclosed, there is very limited disclosure about them compared to the material joint ventures and associates. Now moving to slide 24 for structured entities, the requirements in the standard require disclosure in relation to risks and in relation to the nature of the risks and the nature of the interests that entities have in unconsolidated structured entities. So these types of disclosures apply for consolidated and for unconsolidated structured entities. And these are new requirements introduced by IFRS 12 with the idea that it's important to communicate the nature of the interest as well as the risks associated with the interest. On the next slide, we've provided a hypothetical disclosure example of the way an entity could respond to that sort of disclosure requirement. So in this example, the group participates in a revolving securitization vehicle, which we're calling in this example Vehicle Y, for trade receivables. And this means it transfers its trade receivables on sale of goods to Vehicle Y. Now, the group has determined that Vehicle Y is not consolidated because the group does not control it based on the control definition that's in IFRS 10. So the group also determined that it should not derecognise its trade receivables upon transferring according to the requirements in IFRS 9. So because of this securitization requirement, the group has exposure to risks of default on the trade receivables, and the table in this slide discloses the maximum exposure to loss as well as the total trade receivables, and that's within the statement of a financial position. So going now to slide 26, we just would like to summarise. We've given you a very high-level view on disclosure requirements of IFRS 12. We've given you some examples just to give you a flavour of how some people choose to follow and meet those requirements. And we've also got some questions that we'd be very interested in hearing discussed by the panellists and through audience questions. So the first question is the question of PIR itself in the request for views document, and that is, do you, users of financial information, receive sufficient information for each of the areas in IFRS 12? So we're asking people, is there information that's disclosed that is irrelevant? And we're asking people if there's information that's missing. And if information is flagged as missing, it helps us if you tell us how it is that you would use that information if you had it. Also today in our presentation, we've raised a few questions relating to the research that we did. And so on slides 21 to 23, we had some questions about segment information. So we're interested to know how you use that segment information if an entity provides it. And the second aspect of the question was, what information do you use when investments in joint ventures or associates that are not individually material and are not disclosed separately? So we had a couple of slides and examples there for you showing quite detailed disclosures in relation to material joint ventures and associates, but then when they're immaterial and they're aggregated. So we'd be interested in comments you might have on that. With that, I think that brings me to the end of my prepared comments, and I would now like to hand back.
Yes, thank you, Anne.
Thank you, Saskia.
I'm already speaking before my turn. Thank you very much for giving us the insight about the post-implementation review, also by giving us a number of examples and specific questions which the panel of users will help to address. There was one question for you, and that is from the audience, and they asked if the IASB has found research or studies that assess how well the IFRS 12 disclosures have been provided in practice. And we will also come back to that in the panel, but just to know if there is any research, so especially from your background as academic, I guess this is a relevant question for you.
Yes, we haven't been able to find very much, Saskia, so we would be interested if anyone's listening and they're aware of research, please email us. One of our technical staff, Anna Simpson, collects research, so that would be asimpson, ASIMPSON, @ifrs.org, if you are aware of research on IFRS 12 disclosure. We have looked, we've done extensive searches ourselves, and so, we're really grateful to be able to participate in this webinar today and our other outreach activities to hear from users of the standards, because we're finding that there hasn't been a lot of academic research on the disclosure issues. There's some, but there's not as much as we'd like to see. Thank you, Saskia.
Thank you, Anne. So we can invite the audience as well to type it into the question box, where you can also type in remarks if you have something relevant, so that we can pick it up. Then I'm now going to hand over to Hans Buysse. Hans Buysse is actually connected to 3 of the organizations organizing this webinar. He is chairman of the Belgium Association of Financial Analysts. He is also a member of the EFFAS Executive Management Committee. And perhaps very important, Hans is our EFRAG Board Vice President. So Hans is going to introduce the panel, moderate the panel, and I'm going to hand over to him now.
Thank you very much, Saskia. You can all hear me well? I see not, so that's okay. Very important. While I will introduce the panel, you will receive a second poll question to the audience. So please do have a look and send in your answers so we can use them later on. And also, as Saskia said, during the, let's say, the panel discussion, if people would have an urgent question, please to post the question as well. We will then try to respond to that as quickly as possible. As Saskia said in the beginning, we had to change our panel a little bit, but no worries. We have seasoned panel speakers, and I will start quickly introducing them. You will, as Saskia said, also find their full bios on the website. But the first panel member is Marietta Miemietz. She has over 20 years experience as a European pharmaceutical and healthcare sell-side equity research analysis, which is a very interesting angle. And also Marietta has also looked at, I can say that as the EFFAS board member, as the two sides, also to the CFA side of the analysis, financial analysis. The second member, of course, in our panel is somebody that most of you will know as well, Sue Harding. Sue Harding is an independent company reporting and governance analyst with more than 30 years of experience, ranging from performing equity and credit analysis, developing and interpreting IFRS and US GAAP. She's coming from the banking sector originally. And the third panelist or panel member that we have is, of course, Serge Pattyn. Serge is also an analyst that used to work for KBC Bank and was a credit analyst and a corporate finance expert. He then moved fully to full financial analysis, and Serge has been an EFRAG tech member for over 6 years. He's a fellow board member also at the Belgian Financial Analyst Association. This is our panel. So, ladies and gentlemen, if you agree, I would like to start with the first question, and we are going to start with IFRS 10. And then the question, of course, is what are the experiences with group accounting? Are they easy to understand? Do we have enough information? Is information understandable? And I would like to give the word first to Sue, specifically on this question. Sue, what is your view?
Okay, thank you very much, and thanks all for joining. I suppose this is one of these opportunities where we sort of, step back and try to look at a standard. It's not always easy for our user to look at a single standard. I suppose you'll find most of my comments and thoughts drift quite naturally into disclosure, and in this case that would be IFRS 12. But I think this is one of these chances where if stepping back, it reminds us of what is the investor's shareholding in. It's a residual interest, but what's it in? It's in the holding company, of course. Yet we're really faced with these group accounts. But that holding company is quite essential, and that's what our shares are held in, and of course dividends are paid by the holding company, etc. So then we have this wide array of scope and scope of the group in the accounts, and the method of inclusion of its holdings in turn. There's a very different picture given depending on the method, from full consolidation through to part inclusion for a joint venture. We have equity method. We then have investments that are held at fair value. So it can be quite difficult from user standpoint. I think as users, we can't always tell what we might be missing. I should say I've got a background in banking, but it's sort of equity analysis. I'm not a banks expert in particular or anything, and I haven't specifically studied this topic either. I think it might be one that does require some specific studying in terms of the IASB actually seeing what's happening. I mean, it strikes me as where we are. We started with concerns of off-balance sheet liabilities suddenly turning up. We've been through Enron, we've been through the financial crisis, and now with the suite of standards, we may now have shifted to whether there's is there access to cash that's included in the balance sheet? Is there access to the other assets that are included as greater consolidation is taking place under this standard? Those are the sorts of questions I'm hearing from investors, analysts that are trying to model. There's still very much a focus on valuation metrics that's needed in terms of producing valuation models, but access to cash and risks in terms of obligations and other things are still very much at the fore. I don't know if there's an accounting fix that's needed at this stage. That's to be studied, or disclosure. I think for the most part, I'll probably focus on, disclosure of particular insight. In particular, we need to know why accounting judgments have resulted in a particular conclusion, that conclusion being whether to consolidate, whether to apply the equity method or whatnot. The standards right across in terms of creating these group accounts require loads and loads of judgments. That's not unusual for accounting, but we really need to know the key factors and the considerations taken account of that have resulted in a particular method of accounting. Looking at the IASB slides, there's an example on slide 12 that just illustrates this point. The disclosure was, we're unable to exercise significant influence, therefore, that led the accounting judgment. Well, that tells me they read the standard. It doesn't tell me really why the conclusion has been reached that they are unable to exercise significant influence. So I think that's one of the things in group accounts that we should be aware of. Acid test, I'm hearing a lot that some things are treated differently by different entities. Acid test is same things should not be treated differently, and different things should not be treated the same. How would we know? I think generally it's quite difficult unless we get some insight from those that maybe have an insider view. So the preparers, the auditors, the regulators that have sort of dug into some of these things can be quite helpful in forming. I would hope that the review takes account of these. And I think the disclosure is not only fundamental to the principal basis of the standard, as Anne said, but it's absolutely fundamental to a proper understanding by us of the reported information in assessing these various methods that are actually impacting the group accounts, but impacting them very differently depending on how which method and the accompanying disclosure has been applied. I'll stop there because otherwise I could go on about disclosure.
Thank you very much. I saw Marietta smiling when you mentioned the accounting fix. Marietta, would you like to react to that?
Well, I smile all the time, but I would definitely say that no matter how good the accounting standards, whenever an entity is not fully consolidated, the complexity of the analysis just goes through the roof. And, whenever an entity is not 100% owned, really. And I think I will illustrate that in more detail later on when we get into more granular discussions about joint ventures. But one very high-level point I would really like to make at this stage is that it is very difficult for a user when an entity's status within the group actually changes. So, for example, if a previously fully consolidated entity becomes a discontinued operation or an associate, and you have this issue with companies constantly pruning their portfolio, revisiting their portfolio, thinking, do we still have the right structure? Are we still in the right businesses? And so there is bound to be an element of various activities just bouncing around in the financial statement. And I would just like to give one example, or actually two examples. One is we had two companies doing an asset swap in my sector. And so it became straight discontinued operations. And by the time the transaction actually consummated, we had zero information about these activities because it was literally just, a profit figure that we were given at the end of the day. And we had another issue where a company decided to exit a major activity. And it was crystal clear, because it was a very complex transaction, complex big business, that it would take years to actually divest it, and that they would need to sell it piecemeal. So the issue is it remained fully consolidated after they had made the decision to exit, because they just weren't sure if they would be able to exit it quick enough to make it discontinued operations, and they were afraid of having to reconsolidate. So the divestment process was actually well underway by the time it became discontinued operations. But it was only in discontinued operations, during a blink of an eye, because then they sold another tranche and suddenly it was an associate. And every time that happens, you get a restatement of the accounts. And now in practice, analysts do different things. Some actually in their models, and we have models that have, some historic trend and then future forecasts. Some analysts actually restate their models, others don't. So I actually think, if you are an investor and you look at an analyst model, and you look at last year's numbers, and there was this bouncing around of an entity in the financial statement, I'm not sure that you're going to be able to figure out how much of an activity was included in which line in the past. And so I think these are just, some of the issues to keep in mind. It's all well and good to discuss one accounting standard that relates to one particular joint venture that is present at the moment. But it's another issue when you have to actually look at the whole company, and the structure of the group keeps on changing. And so I think I'll stop there, and we'll probably discuss some of the other issues in more detail. And I think Sue has already brilliantly explained the complexity that we face.
You're on mute, Hans.
Yeah, sorry, I do apologize. So Serge, I'm not going to give you the floor on this question. I'm going to move first to the questions that we've seen from the audience. There's two long questions coming in. I will read them out together because I get the impression they really tackle the same topic. First question was, why is the rationale for holding an investment not a requirement? The example where 25% was held but there is no influence was a concern. Should users not be given a commercial explanation for why the capital is being deployed into an asset without influence? Where there are multiple immaterial associates, there is a real concern about the lack of information. I would want more information. How many are loss-making? Is there a common commercial strategy? What is it? We should always remember users are trying to understand economics to derive a valuation. This is where Marietta comes in. I will check the second question as well, and then give the floor back to you. And the 20-50% ownership for significant control, and that is in reality already a question for the next topic, but okay, is artificial and does not take into account what is the relationship to other owners. If there is one owning 70% and the another 30%, the control is different than if one has 30% and the next biggest has 5% and the other even less. Is there any plan to address the significant control issue in associates? The first question, who would like to respond to that one? The example where 25% was held, but there was no influence was a concern. Somebody from the panel, ladies and gentlemen.
I'm happy to give a brief answer if you want me to.
Yes, please.
So, I think this is sort of a very general issue that we find when analyzing companies, is that you always have a risk that, almost everything they do ends up in the other line because, if they have a fairly fragmented business, and for example, in my sector in pharmaceuticals, you just have a lot of different drugs and they might be owned through a lot of different structures. So a lot of these areas might be fairly immaterial in and of themselves. But definitely, I think, we need to understand them in the aggregate. And, if a lot of them go wrong, then, all your forecasts for the future are wrong and, the stock price plummets. So definitely, I think, we should always get a full explanation of how capital was deployed, why it was deployed that way, what the company we cover is really trying to get out of this. I think, we'll get to the subject of control, I think, a bit later on.
Yes.
ultimately, control is a spectrum. So, you might have a little influence or a lot of influence. And, I definitely would want to understand how much influence the company has. And if it has zero influence, why it's still holding on to the stake. And we had a case where, a pharma company had a major associate for a really long period of time, or had a stake. Well, had a stake in a very big pharma company for a really long period of time. And people were asking them, why are you still holding on to it? You're not going to be able to take them over. What is the point? And they basically said, it's a financial and strategic investment. And so that sort of boilerplating really doesn't get us very far. So I think definitely I would want to understand management's thinking in a lot more detail.
Thank you very much, Marietta. Okay, that was also partly a question to the question on control. We will also go further into control right now as soon as we hit the second question, which I'm about to ask. Important again to the audience, during the discussion, there will again be a polling question on the concept of control and the understanding of group structures. But the second question is, does the panel have views about the concept of control, where we know the definition of control, and an investor controls an investee when it is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. Marietta, are you prepared to go a little bit deeper on this one?
Yes, definitely. And I would say, I think this kind of echoes some of the things that Anne and Sue have said, that the starting point of my analysis is not really control. The starting point is what proportion, what sort of stake does my company have in the venture? What sorts of cash flows are they ultimately going to be getting out of it? And I think, that's really why you find some support among some users for proportionate consolidation. At the end of the day, it's very difficult for me to forecast joint ventures because I basically need to take a view on the whole P&L and balance sheet. But actually, a lot of times all I get is, the stake and the profit, and I work it all back from the minority line. So it's quite difficult to do the economic analysis. And then in terms of the actual control, of course, I need to understand what decisions were actually taken and why. But I don't try to visualize the boardroom battles that went on in the background in a whole lot of detail. I think it is important for me to understand on what aspects my company has a de facto veto right. So, I need to have the confidence, I think, that they can block some potentially really bad decisions, or that they have the power to force some decisions that are absolutely necessary for the venture to succeed. But I do think that ultimately control for me is not a binary issue. It's really a spectrum. And we have a lot of situations in pharma where assets are shared in some shape or form, and and there are some areas where a company has almost complete control over it, and then there are more granular areas where there are a lot of difficult discussions taking place in the background, and different people have casting votes or deciding votes, or there might be financial penalties attached to certain things. And ultimately, there's also such a thing as economic compulsion. So you can look at the contract and say, okay, this company is just a junior partner in the joint venture. But if they hold a put option at a time when the senior partner has balance sheet issues, they might be able to exert quite a bit of pressure. So I think for me, this concept of, yes, there is control, and so it needs the accounting treatment is this. And if there's no control, then the accounting treatment is that, is really a massive simplification of the very complex contracts and arrangements that we see in reality.
Okay, thank you very much. Sue, your points over power over an investee, control without a majority of voting rights, the concept of control. How are you aligned to that?
Well, I think Marietta is inevitably correct. There's a whole spectrum of circumstances that the accounting is attempting to address. I suppose some like the idea of control as being that sort of operative that says either consolidate or do something else. I guess my view on control would be that, yes, we do need that switch at some stage to say consolidate this and others go into a different assessment. It's a difficult one, and any of these, I don't think bright lines are the way to go. That's been attempted in the past. I think though what I'm hearing on this standard is that there have been, say, some auditors taking a very strong view on most everything is controlled and should be consolidated and really pushing in that direction. And again, that may be a sort of a backlash against the Enrons, the financial crisis, the off-balance sheet situations that had been held previously. It is worrying that there might be different outcomes. So I think that the interpretation of control needs to be looked at in practice through the review. And that's work to be done as part of this review. But I think inevitably we need to come on to something that can indicate what we consolidate or don't. I think it's sort of working better than it had been working, but maybe needs a bit of a look in the context of this review. It's a significant judgment, so yes, we do need to know, why it's held, what it's supposed to be doing. It's sort of fit in the business model and mix of the company. It's that why that we need a bit more disclosure of why is something consolidated or why is it not consolidated. And it's going to be binary in terms of it is or it isn't. It is, but yes, if it has a significant minority interest, then we've got the NCI issue to deal with. It is inevitably going to be complex, but it's trying to simplify something that's an awful lot more complex.
Okay, thank you, Sue. I have a very specific question for Serge. Serge, within that control area, what if a subsidiary is not integral to the business?
Well, Hans, first of all, I think the notion of control is a very good starting point to build group accounting upon. But indeed, thinking about this, I all of a sudden thought about the primary financial statements project, where the IASB introduced integral and non-integral associates and joint ventures, a new concept with which analysts are struggling for the time being. But I all of a sudden thought, is it something that could be introduced when you talk about control, subsidiaries, because control then leads to full consolidation? Would it make sense to define integral and non-integral subsidiaries? Would it make sense? Could it make sense? Would it make financial information in a few particular cases more useful if a subsidiary was not consolidated? And of course, users would need information around that. If you say, okay, I've got two subsidiaries that I don't consolidate because they are not integral to my business, fully in line with the approach in the primary financial statements project. Would that make sense? It could make sense, in my view, if you would say, look, the information in the operating segment of the P&L becomes more relevant because you're not mixing up things that you should not mix up. To be honest, I haven't made up my mind myself for the time being, but it's probably something that could be reconsidered when looking at the group accounting framework as it stands right now.
Okay, thank you very much. In the meantime, we have the results of polling question 3. So does the concept of control allow users to understand the group structures? What did we see? We saw, first of all, no changes required. That's 6.45%. We then see, and I'm already thinking about what Sue just said, yes, but additional guidance is necessary on certain subjects to improve, or maybe, Serge, on what you were saying. We see 58% says, we agree, but there is still some guidance necessary. Then, of course, does the concept of control allow you to understand the group structures? Almost 10% think that the answer is no, but the issues are not frequent, therefore no additional guidance is necessary. And then we see still 26% who says the concept is Not allowing users to understand the group structures, no, and the issues are frequent, therefore additional guidance is necessary on certain subjects to make it useful. Is there anybody in our panel who would like to react to those results? Sue or Serge or Marietta? Or do you say like, oh yeah, we know this one?
Oh, I think, it's telling, isn't it? I think it was 58%. It's
58%
roughly
says yes, but a little bit additional guidance, yeah.
Some guidance. I mean, that's kind of where my thinking is at the moment. And, if people have views on specific aspects and areas and sort of transaction types that they know are getting different outcomes, obviously that would be very helpful to bring forward, because it is not generally apparent in reading the accounts where that is happening.
Yeah, thank you, Sue. And the 25, I was surprised, 26% says no, it does not help us.
And I would like to comment on that as well. I think it's very good to have guidance, and of course, the preparers will need guidance for each individual arrangement to see how exactly they can reflect it in their financials. But I think that the need for guidance really shows, how much judgment is really involved, and how blurred the lines are between control and no control. And I mean, I can definitely say, as an analyst, I'm completely and utterly incapable of taking the skimpy disclosures on the contractual arrangements that I get from the companies, putting them next to the accounting standards and trying to figure out where in the financial statements this activity is going to sit. I basically have to go back to the companies and ask them if I can't fully figure it out from the accounts, and actually if it's an arrangement that has just been concluded, and I want to forecast it for the future. If I go back to the companies a lot of times and ask them, where is this going to sit? A lot of times they might just reply, well, we have yet to decide with our auditor.
Okay, thank you very much, Marietta. There's a question coming up from the public. I will ask it to Serge. I would support the option for proportionate consolidation for equity consolidated JVs, maybe with a minority interest for non-ventures. This may lead to better audit reporting as well due to pervasive quality, which perhaps eludes equity accounted investments. Serge.
Yeah, I have sympathy for the question, honestly. I mean, I refer back to the primary financial statements project. If you say an associate or joint venture is integral to the business, and of course there's a definition in the discussion paper which I can't repeat now, but it speaks for itself. If you're integral, if you're part, if the joint venture or associate is part of what the group represents in terms of business model, just to give one example. Somehow I feel sympathy for the idea. Let's consolidate proportionally. Then, from my perspective, it would add value to the operating section of the P&L statement. I've understood from the IASB that to revise proportionate consolidation is not on the agenda for the time being, but I would absolutely support the idea of where, how, when could we reintroduce a proportionate consolidation, especially as the IASB now plans to introduce integral and non-integral investments. There's some work to be done there. Yeah, absolutely.
Does anybody want to react? Marietta or Sue or Anne?
Yeah, I mean, I would very much like to make a general comment from a very practical perspective, which is I think that proportionate consolidation would actually reduce analyst forecasting errors, because we're generally quite able to forecast, the future profitability of segments, even if they include some JVs. You get a steer from the company as to why margins have been developing the way they have been developing and where they expect them to be going. But when you have a majority-owned JV, where you really, hit a roadblock is when you try to model the minorities line, because it's basically just one number. And as I mentioned earlier, you basically then then have to suddenly invent a whole P&L for the joint venture to figure out what the minorities are. And ultimately, if the EPS is wrong, it just destroys confidence in the market. So I think in some ways, it would just help from a very practical perspective.
I see that Serge still wanted to react, and then I see that Anne also has a reaction. Serge.
I would like to agree with Marietta on this, indeed, because I think most of us are still struggling with equity method, how it's been. Well, we all know what equity method is, but there's a project on the table with IASB to study or revise or analyze the equity method as such. Is it the consolidation method? Is it the valuation method? What it does? Is the information that we get because the equity method is used absolutely relevant, or could we do something about this? Does, in combination with it, would proportional consolidation not be better in certain circumstances? Yes, it absolutely makes sense. Would make life easier to some extent for the users too, especially if associate joint ventures are, as already said, integral to the business of the group.
I think we need to listen to the IASB, Anne.
Thanks. So the IASB is considering the feedback on integral associates and joint ventures as part of primary financial statements, and that'll come up in the months ahead. But lots of feedback and feedback from the analyst community as well, with some concerns about how this new concept integral would be applied. And quite a lot of negative feedback in the comment letters on the idea of integral associates and joint ventures. So indeed, that one may not fly. And in relation to proportional consolidation, it's good to hear the comments today. For some people, it's still a very sore topic, in the sense the change was made, the decision was made when it was. I believe we'll get quite a bit of feedback in this round of review, and that will come to the board for discussion. As has already been mentioned, there's no active plans about reopening the standard, and in a PIR it's not about reopening the standard and changing what a previous board decided on. But it is about listening to what people have got to say in terms of, are they getting the information they need? And that's what this meeting and other meetings are doing for us. So thank you.
Thank you, Anne. Being conscious of time, I need to speed up a little bit, so we move to question 3. For the audience, while we are going to discuss question 3, there will be 2 polling questions again passing by, one on the investment entities exception and one, of course, on the sufficient guidance to assess whether an entity is an investment entity. Question 3 is, does the concept of an investment entity make sense to you, or would you prefer that all subsidiaries are consolidated? What is the definition of the investment entity then? The entity that obtains funds from one or more investors for the purpose of providing those investors with investment management services. Serge, may I ask you this question?
I absolutely agree with the concept of the investment entity that does not have to consolidate its subsidiaries, because if you look at the business model, the idea is not to manage a group that is active in a certain sector, retail, transportation, what have you, chemicals. So that's quite clear. By accident, Belgian analyst has quite some experience with investment entities. Many years ago, we had numerous Belgian holding companies that would qualify as an investment entity, and we still have several listed on the stock exchange. So absolutely, the IASB is correct there. Just one concern. I'm struggling a little bit with the definition. It says obtains funds from one or more investors. I have the impression that it gives the impression that the investment entity starts off today. The entity obtains funds from one or more investors. And my question is, what if a big conglomerate active in whatever sector would decide today to develop investment entities activities? So it's clear that you should try to define what is an investment entity activities, and if that is the case, and it could be any conglomerate wherever in the world, if that group develops investment entities activity, they should be allowed to fair value those subsidiaries. And it also refers a little bit back to my response to question 1 or 2 when I said if a subsidiary is non-integral to the business, if it's somehow an investment done as an investment entity, does it make sense then to consolidate or not? My response to that would be no, it doesn't make sense. So we should work on the definition and say, look, big conglomerates can develop investment entities activities, of course, and in that case, consolidation should not be necessary. Fair value should be okay. Just one additional concern, Hans. I've looked at the P&L from one investment entity in Belgium. We won't give the name, but I was a little bit, well, frustrated is not the right word, but let's say 80% of revenues were fair value changes, and 90% of the operating costs were fair value changes. And then, of course, the question then pops up: well, is this? Of course, it's relevant, but it is transparent. Where do these value changes come from? So you would need good disclosures about how fair values are measured, but that's of course not part of this debate. But yes, I agree with the exception that the IASB has built in.
Okay, thank you. Sue, your point of view on those on this exception that the IASB has built in?
Yeah, I wouldn't say I have vast experience with this one, but I think generally, as Serge said, it seems to work for me in concept. I guess it's then down to others that may have more direct experience, or there are issues around the perimeter that have some challenges or questions to them. But I think this one generally works for me as well.
Okay, thank you. I see that we have another question from the audience saying, an investment company, a subsidiary dealing in mutual funds, has a significant influence in terms of the investment in the fund itself. Do this mutual fund require to be consolidated with the parent? Question mark. Ladies, gentlemen of the panel, any reactions to this question?
I don't know, Hans, whether I understand the question correctly, but I think it's what I tried to say. We would say we develop everywhere in the group investment entities activities, then those activities could be fair value as far as I'm concerned, and should not be consolidated.
Not be consolidated.
Not be consolidated. It's a tricky one, of course, but if you manage, if you hold on to certain investments because you want to collect the dividends or you want to simply create value, so in that case, if that is your business model for those specific investments, then fair value is the best option. Because by consolidating all those entities within the group, might be that you're mixing up things that you shouldn't mix up.
Any reactions from our other panel members? Do we agree? Marietta or Sue?
Yeah, I think I'd agree with that, if I've understood it correctly.
Okay, super. In the meantime, we have our reactions on the polling questions, and I now need to look at, because my screen is a bit going in any possible direction. So we said, do we agree or do you agree that the investment entities exception is useful? And what do we get? We get as responses, if I'm not mistaken, 35.29% said, yes, for this kind of entities, the fair value measurement provides more useful information compared to a full consolidation. I get 11% or 12% that says yes, but the criteria to identify investment entities will still leave room for entities to achieve their preferred outcome by choosing to apply or not to apply the exemption. And I get 50% in general, yes. However, measuring at fair value an investment in a subsidiary, which is an investment entity itself, results in loss of information, especially when the investment entity has an operating subsidiary. We have nobody or close to nobody that says no. Any reactions to this fourth polling question, ladies and gentlemen?
I mean, I think that supports the view that yes, it's the right answer.
Okay.
But it's an incomplete answer, and there may be some more disclosure that's inherently necessary to understand that investment. And we shouldn't just lose sight of yes. That. It's accounting and appropriate explanatory disclosure.
Thank you very much, Sue. And then the fifth one, do you agree that IFRS 10 currently provides sufficient guidance to assess whether an entity is an investment entity? I see that the majority here says, first of all, no, not the complete majority, 41% says yes. Yes, a certain level of judgment cannot be avoided. And then we have 32.35% that says no, further guidance should support the assessment of the business purposes of the investment entity. That's also a little bit where you were going, Sue. And then we have still 20% that says no for a combination of the reasons in the other answers. Any reactions to that, ladies and gentlemen of the panel? Or was this expected?
I think it was expected, Hans. I agree with Ada. Yes, a certain level of judgment can't be avoided. I'm just thinking loud about a comment from a reporting entity I saw. They had a 60% stake in a subsidiary, and they explained that they didn't control that subsidiary. And of course, that's judgment. Of course, you get a few paragraphs in which they explain how they collaborate with the other shareholders, blah, 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 blah. So they decided they didn't control and didn't have to be, and that the entity the subsidiary was not fully consolidated. It is what it is. So a certain level of judgment can't be avoided.
Okay. Thank you, Serge. Okay. Shall we move to IFRS? Oh, I see that Marietta wants to react. Marietta, the floor is yours.
Yes, just following up on something I said earlier, I think it is important to avoid any activity bouncing around in the financial statements as much as possible. So for me, one of the concerns where there is a lot of judgment involved is that what if there is a tiny tweak to the contract where the company changes its auditors? Is it going to be suddenly consolidated next year and then deconsolidated again? And I think, changes to contracts and so forth are quite common in our industry. So I think that might also be something that should be taken into account when the initial judgment is made, is what is the likelihood that, this activity will still have the same status within the group, next year and the year after, if economic reality changes, some aspects of the contract change, and so forth.
Yeah. Thank you very much, Marietta. I see it also Serge reacted indeed.
Yeah.
Even when the IE develops corporate finance advice. Serge.
With regard to the investment entities, it's quite clear and might be confusing, but I can imagine that a lot of investment entities are investment entities, but they have a bureau that gives fiscal advice, corporate finance advice. There's all kind of things or render services to their clients. So those aspects of the business should, of course, be consolidated to the extent possible. So it's in practice, it might be a more tricky exercise to separate the investment entities' activities from the non-investment entities' activities.
Thank you very much, Serge. We will move to question 4. It means we are entering IFRS 11 on joint arrangements. We have heard that it can be difficult to distinguish between joint ventures, where the entity has joint control over the arrangement, and joint operations, where the entity has a direct interest in the assets and liabilities of the arrangements. I would like to give the floor to Marietta to see whether she has cases where this distinction is difficult, feasible. Does it give you the information you need, Marietta?
I think in very general terms, there is a lot of complexity around the joint ventures in my industry. A lot of times it's not just a question of, straightforward sharing of economics, 70-30 or something like that. You have a situation where the outcome of any one asset is highly uncertain and nobody wants to take the full downside risk, but nobody wants to miss out on the upside entirely. So you tend to get things like put option arrangements, preferential dividends, and so forth. And just to give you a couple of examples, that caused a bit of a ruckus in the investment community or in the analyst community, I came across one example where the senior partner in a joint venture actually felt compelled to tweak the contract in order to allow a put option liability to be put on the balance sheet. And this really made me wonder how often the accounting dog actually is wagging the business tail. Another example is an estimated royalty obligation had to be carried on the balance sheet because it was incurred in the context of a business combination. And so it's basically considered contingent consideration. Now, in terms of the actual contractual arrangements, it was no different really from a straight licensing deal where a pharma company says to a biotech company, okay, you got the drug, we got the marketing muscle, we'll sell it for you and pay you a 15% royalty. And in a straight licensing deal, it's not on the balance sheet. So you do have these sorts of mismatches. And I think generally, I touched on this, it's very difficult to get complete information on joint ventures. So it always presents some analytical challenges because you don't get the complete P&L and so forth. And once you fall below the joint venture level, in my sector, you really have a very wide range of contractual arrangements. And the simplest ones that I mentioned, the straight licensing deal, you really cannot tell from the primary financial statements that that there is a pay away or how much that potentially is. So definitely, I think in terms of disclosures around joint ventures, there can never be too much.
Thank you very much, Marietta. Before I give the floor to Sue, one small remark to the audience. There is poll 6 and 7 has been sent around. Please do not forget to fill that in. Sue, your reactions.
Yeah, well, all right. We know we're in trouble when acquisition accounting meets joint ventures and jointly controlled entities and the like.
Okay, thank you.
It's complexity meets more complexity. I mean, I guess I think my sense is that these sort of arrangements are, if anything, going to become more and more popular. We've seen in sort of the last year all sorts of things happening in probably pharma, which Marietta would be much more attuned to. But I can think of other industries as well where this kind of collaboration of some sort is going to be absolutely key to developing things in future and being a bit more nimble. I guess my question would come down to just how optional the accounting is, because of course you're getting a very different answer whether it's proportionately consolidated or it's going to be equity method accounted. I think that the information that's needed is probably very similar, irregardless of which side of that line it has fallen. But the information provided to us in terms of the financial statements is going to be very different, part consolidated versus equity method. I think this is one, again, where disclosure, at least high-level disclosure of if it's partly consolidated, what are the related amounts that are in the account, so disaggregation of the reported amounts, in other words. And on the flip side, we kind of need as much mirror information if it is equity accounted. What's kind of the breakdown? What does that balance sheet look like? Underlying balance sheet, income statement, and cash flows look like? Because at the end of the day, the objective is going to be the same. Investors are looking to value and assess risk. So virtually the same information is going to be needed, whether it's in partly or equity method accounted.
Okay, thank you very much, Sue. Serge, anything to add or anything on the evolution of the last years, or how do you see this happening?
I have no specific experience with complex joint arrangements, but okay, the message to the users should be clear. If you know about structures that don't work in practice as of today, I would say pass them on to the IASB and they can see where they fit into the model. Yeah, it should be quite clear.
But I heard from Marietta and from Sue that additional guidance is needed. Let's have a look to what the poll question said, because that was specifically on that one. So question 6 was, do the current IFRS 11 requirements result in useful information? Oh, we have a very clear answer here. Says almost 2/3 says yes, but additional guidance is necessary on certain subjects to improve. We do have, however, 19.5% saying no, and the issues are frequent. Therefore, additional guidance is necessary. But it means that in the 2 cases, additional guidance is necessary. And then, of course, the poll question 7, do you consider that further guidance needs to be developed on collaboration agreements? And there we see again 47%, close to 50% says yes, such agreements should be presented in a similar way to joint arrangements, but without the assessments of joint control. And 33% says yes, entities should apply the simplified criteria, example given, whether a separate vehicle is involved and recognized as either joint operation or joint venture. So that's also an overwhelming response to yes, more guidance is needed. Would you like to react to that one? Anybody from the panel, or can I move to question 5? I see no hands up, so I will move to question 5, also being considered about the time where we are. And it means we hit IFRS 12, with the main question is, how does the information in the financial statement really meet your needs? Too much or too little or just right? What is the real thing that we see here? Marietta, may I give the floor to you on this one? And
yes,
again,
thank you.
One small remark again, there will be polling questions 8 and 9 moving around. Thank you, Marietta.
Well, I guess, those of you who know me know that my answer to this kind of question is always we get too little information. But I think in this case...
I agree.
I think in this case it is particularly pertinent because, if you look at what the IASB is doing with the primary financial statements, this is really a project for the users to get much more granular information about a company's operations, about their margin structure, about their cost structure, and so forth. And, this is all well and good so long as, an entity is owned 100%. But as soon as you get into the joint venture issues, all of this gets distorted and a lot of information is lost. And definitely, if I try to analyze a joint venture properly, I need to piece together the information that I need for my modeling from a number of different sources. So, for example, the annual report might tell you the stake in the joint venture, but if you want the formula to calculate, how the stake might evolve in the future, you might need to go all the way back to the initial press release when the joint venture was first formed. Or, if you're trying to get information about the profitability of a joint venture, you might have to infer a lot of it just from your knowledge of the industry. And then you might suddenly remember that, the CEO or CFO made a comment at a capital markets day or in the Q&A session of an earnings call where somebody asked the question that the margins are somewhat different from industry average for reasons X, Y, Z. And if you don't actually follow a company closely, that information can be quite difficult to find. And so I think, one of the big issues just is really the complexity because, I think I made it clear that I a lot of times struggle to model joint ventures correctly. And, I'm still an analyst who is building full models. And on any company, you only have a very limited number of analysts. But you have a very wide range of users, including investors who have hundreds, if not thousands of companies in their investable universe. And so they don't even have the time to read all of the disclosures and the notes of the primary financial statements. But the face of the primary financial statements really does not necessarily tell you very much. And I think, one of the reasons people very much look at alternative performance measures and, many analyst investors now almost disregard IFRS earnings is, for example, because it's just too difficult to figure out how the discount unwind on the put option liability is going to work its way through the reported P&L. And so they prefer to look at a metric that just, ignores this and just looks at the overall business, which is all well and good so long as they're still aware that these alternative performance measures really strip out a lot of the actual economic costs that needs to be incurred in order to run the business. And I'm not convinced that's always the case. And I really hope that the management performance measures are going to be very helpful in that regard. But yeah, the bottom line is the complexity just goes through the roof, and some of it can be addressed with accounting. But to some extent, I think we just have to say if a company has a lot of joint ventures and integrates complex structures into those joint ventures, it has to take a risk of it becoming unanalyzable and the cost of capital going up. That's just the reality.
which is, of course, a reflection of that risk. Yeah, I agree. Sue?
Well, I guess the word uneven comes to my mind in terms of the disclosures that we see. And obviously, it's a principle-based approach, so some of that is inevitable. But I think, sufficient disclosure needs to be made. And you sort of go down the spectrum of consolidation. Well, we're reliant then on segment information, insight on restrictions. And I have to say, anytime I see disclosure illustrated of restrictions, so restrictions on, say, cash or access to other assets, it always seems to be legal restrictions. And I think investors are interested in not just the legal, you can't transfer the currency type disclosures, but disaggregation and understanding where the cash and the debt is always very important. One thing I don't think we've really touched on is the non-controlling interest. I would share the view that we need some greater clarity on the assets, liabilities, earnings, cash flows that are subject to that NCI claim so that we can associate. So that's a disaggregation issue as well, and showing what is part of that claim, essentially. And then you've got your joint operations. We talked about that already, but then equity and sort of fair value methods. It may be that summary of the detailed summary of the financial sort of comprehensive financial information is needed. And I'll just highlight one example that I'm actually going to go back to. I was looking at a company that, and if you think of the net presentation of individually insignificant equity method investees, for example, we've got netting problems. So then you've got a portfolio issue, and problems may sort of hide within that. We've got a company that has a significant dependency on R&D. They need to sort of meet climate obligations that they've committed to and reduce emissions. They need significant R&D, new practices to reduce emissions. R&D is flat, as near as I can see in the consolidated entities. So just sort of wondering if there's material information that's hidden in the sort of the net, the associates and joint entities, where they are actually investing collaboratively, perhaps. How are they going to get themselves out of this hole? It would be material information to know if in that net profit or loss, for example, of the associates, there's some costs being invested there that may be their hope. That would be material information. Or is it just loss-making associates that they have? I mean, these things can be material, even though they're sort of down a few layers. But it's back to the why they're holding the entities anyway, and it's part of telling the full story.
Thank you very much, Sue. I see that Marietta has her hands up. Marietta?
Oh, apologies. That must have been an accident. I didn't raise my hand. Sorry.
No problem. Serge puts his hand up. Serge?
Yeah, just to comment on IFRS 12. I'm pretty happy with the standard, at least. I'm pretty happy with the objective as worded in paragraph 1. However, in practice, I'm afraid users are not always that happy with how IFRS 12 works. And I have a few examples. I found one reporting entity that just gives a list of its subsidiaries, associates, joint ventures, just one list. Unclear what the subsidiaries are, unclear what the associates or the joint ventures are, no percentages, whatever. I found one annual report with a very interesting table referring to the transactions with minority shareholders. Very interesting, but also means that a lot of entities that don't produce that table. That information is then less useful, of course. And I agree with Sue on this. The transactions with NCIs are very often complex, but interesting, important to understand. I have one entity that says my subsidiaries are, so you get this list, and a lot of the subsidiaries the entity holds a 50% stake in. Somehow they are nonetheless subsidiaries and are consolidated. But you also have a list with joint ventures, and in a lot of the joint ventures they have a 50% stake. So why is one entity a subsidiary with a 50% stake, and one is another one a joint venture with a 50% stake? Of course, the answer of the entity will say that information is not material and won't influence your decision. But nonetheless, if you look at how IFRS 12 is applied in practice, you find a lot of issues that are disappointing. So there's nothing wrong with IFRS 12. There is a problem with how it is applied in practice today. Because if you ask me the question, do the notes allow you to assess the nature and the risks associated and the interest in other entities and the effects of those interests in financial position, cash flows, and financial performance, as stated in paragraph 1 of IFRS 12, then the answer is, I'm sorry, no. So we need to think about how is this applied in practice.
Okay, thank you. We have still 2 questions from the audience. I still have a 3rd question from control. We'll take it at the end. And I have the 2 polling results. First question from the audience here is, have you considered including industry-specific accounting principle like what has done for the oil and gas industry? Ladies and gentlemen from the panel, who would like to take that question? Or IASB?
But just a short comment, Hans. I'm afraid that's not the way the IASB plans to work. It's a tricky one.
I see Anne nodding, so that's okay.
Yeah, it's principles based. Yeah. And on the other hand, of course, for oil and gas, for mining industry, for chemicals, for what have you, you would like to specific rules and principles, but it's a difficult choice. Once you start there, you will have a list of hundreds of exceptions.
Anne, would you like to add any comment there?
Yeah, just quickly, I know I've got other things to talk about, but I agree with Sergei's comments. It's most people ask us to stay with principle-based approach. Very difficult to get down into the industry-specific. You can see what happened in the US with a lot of industry-specific guidance that then had to be rationalised. A lot of people ask us not to go there. We are looking at IFRS 6, extractive activities, considering whether anything needs to be done in that area. So if people are interested, just watch that project because we will start talking about scope on that soon. But I agree with Sergei, the approach is not to go down industry specific. Thank you.
Thank you. Thank you very much. The next question is, it has always appeared to me that IFRS 12 requires significant information regarding the impact of JVs and associates, which is useful. But I believe that it would also be very useful to know the cumulative impact those entities have had on the separate components of equity. This would clearly show the extent to which components of equity are within the control of the company and the extent to which they are in JVs which are jointly controlled and associates over which the entity only has significant influence. Any reactions to that comment, ladies and gentlemen? I know it's a long question, but
it means we have to think about it.
Okay. Specifically on the cumulative impact that those entities would have had on the separate components of equity.
It's a question to pick up when the equity method is revised, I think, or is analyzed.
Okay, we'll think about this one. I think that's a good answer. I get back to you. No problem. Oh, Marietta wants to react. Marietta, I do apologize.
Yeah, no, I just wanted to say, I mean, very high level. I mean, it would be nice to have this information, but I think in actual practice, based on, what I have seen from other users, I think most people are quite happy with just understanding shareholders' equity, minority interests, investments in associates. And I'm not sure that, a lot of people would really sort of dissect that granular information in a lot of detail, at least in the equity world. I mean, maybe it's a little bit different for credit investors. Yeah, I mean, I've never felt that massive amounts of balance sheet information was missing.
Thank you very much, Marietta.
What you also see appear in equity is, of course, what happens with the OCI, other comprehensive income of your associates. Okay, that might trigger questions because you're uncertain why all of a sudden that information is there. Often those amounts are not very material, so. But yeah, probably some work to do there.
Okay, let's have a look to the poll. Do the current IFRS 12 requirements result in useful information? We see 72% that says yes, but additional guidance is necessary on certain subjects to improve, which is fairly convincing. And question 12 says, okay, IFRS 12 requires disclosing summarized financial information for individually material joint ventures and associates. Some entities disclose their segment information on a basis that includes the entity's share in the joint ventures and associates revenues, earnings, or other amounts. Do you use this additional information when it is provided? We see 41% of the users say yes, and we see 31% says I haven't encountered this information, but I would use it if it would be provided, so which makes a good 70% that would use it. I see that though 22% would not use the information when it is provided. And then I will move to the last question. It is not the last question from the audience. It's a question getting back a little bit to control. It was in respect of the consolidation of SPCs, SPVs, in which there is no shareholding, so 0% interest in the SPV. Should the assessment relating to control be done based on the lending agreement at the level of the entity that has provided the funding? That's a very specific one. Mm-hmm. I recognize the one from Project Finance.
Marietta. Is that one for the interpretations committee, Hans? Or?
I'm not sure. Let's listen to Marietta first. Marietta, go on.
My answer would be yes, but I'm not sure.
Yeah, I know, and it's a tough one because it seems to coming from also the project finance industry. Marietta, you wanted to take the floor.
Yes, I can't really speak to it from personal experience, but I mean, my general approach would be to, if you go with the concept of control, to assess control as best as you can. So if the major influence is actually asserted through the lending covenants, then, in my book, that would be potentially significant control. But I think it really then depends on how the operation is structured, because, if basically the entity is very far from potentially ever breaching any covenants, then in actual practice, the control, the day-to-day decisions might really be made without, the lender really saying much about this. So I would really suggest that you sort of check with credit analysts and companies who have entered into that structure how control is actually exercised on a day-to-day basis in that.
Yeah, probably it also depends if on those covenants, as you mentioned, there is step-in rights from lenders. That would change it again. I fully agree with that. And this, as Serge says, take into account all facts and circumstances would indeed be very much necessary here. Okay, ladies and gentlemen, it's 11:38. I thank you very, very, very much for the input, and I will first of all give the floor back to Patricia. Patricia McBride, that is known by everybody that lives or breathes around EFRAG. But I really want to thank the panel. It was great working with you. Thank you. Patricia, the floor is yours.
Thank you, Hans, and I think a lot of thanks to our panel for a very, very interesting discussion. The overall message we heard was that IFRS 12 is good as far as it goes, but more is needed. And I think our panelists met and Tarca's challenge, not only asking for more, but explaining why you need that more. So on the group accounting, what we heard was that users want to know why the accounting judgments resulted in the classification of subsidiary, associate, joint venture. Not just that it resulted, but why were those factors weighted? There was frequent acknowledgement that we are dealing with a continuum, and Marietta picked up that there's a lot of concern about finding information when status changes along the continuum, when activity moves from maybe consolidation to joint venture. We then got requests for information about economic compulsion. I know it's an idea that we often avoid, but it can significantly affect what's happening in this area. But what the panel, while acknowledging there was a spectrum, acknowledging that particular activities could move backwards and forwards, there was no request for bright lines. So we haven't been, the IASB isn't being asked to put back 50% means control, 25% means significant influence. Serge took us on an interesting journey relating what's been happening in the primary financial statements project, and could this notion of integral and non-integral be brought into the group accounting, and could it also be applied to subsidiaries? With, I think, the implication that for a non-integral subsidiary, maybe it doesn't need to be consolidated. It's certainly something we need to think about more. We also got a request for proportionate consolidation to be reconsidered, because it would reduce the forecasting errors from analysts if they got that more direct information. We got strong requests for more information on risks and cash flows at a more granular level. So there was a request for granularity, as that is critical to an investor's use of it. There was strong recognition of the complexity in this area. People don't fit tidily into boxes, and comparisons drawn between what you might do with a business combination and what you might do in other circumstances. But it kept on coming back to compare risk, compare cash flows, think about the impact of IFRS 5, because once a subsidiary, a joint venture, an associate moves into discontinued operations, we're told that information is lost. We got support for investment entities, and again, this push for granularity. So I think we could summarize by saying, agree with the objective, more granularity, thinking about risk, thinking about cash flows, thinking about what happens as status is changed between specific entities. So given the time, I'm going to briefly say thank you to all of you. We've got participants from the Americas through to New Zealand, both ends of the spectrum. I don't think anybody came from somewhere in the middle of the Pacific. We have a request for you. We are preparing the European response for everything we're hearing at EFRAG to respond to the IASB's request for information. After this webinar, we're going to be sending you a link to our online questionnaire. If you're based in Europe, please complete it. We'd be very grateful for everything you can tell us. And if you are a user based in Europe and have time to share your views in person, the email we're sending to you will provide information on how you could volunteer. So volunteers, please. And finally, thanks to everybody, Jesus, Saskia, Hans, the panel, for their help. So good night to friends in Asia, Oceania. You'll be ready to go to bed. Good evening to Eastern Europe, and for everybody else, enjoy the rest of the day. Thank you.
Thank you very, very much.
Thanks, you,
everyone.
Patricia, for the last words. Thank everybody for being there. We'll bring it to a close.